Welcome to Investing by the Books, a podcast by Redeye. I'm your host, Eddie Palmgren, and with me in the studio is my colleague Niklas Sävås. How are you doing today?
I had a terribly bad lunch, which I managed to turn into a good experience by not eating much. So, all good. How about you, Eddie?
Well, my lunch was much better than yours, so I'm fat and happy here. Today, we are excited to talk with Jeff Gramm, who is co founder and manager of the hedge fund Bandera Partners. He has served on several public company boards, and he taught value investing at the legendary Columbia Business School, famous for both Benjamin Graham and Warren Buffett. Jeff's book, Dear Chairman, Boardroom Battles and the Rise of Shareholder Activism, was named one of the best books of 2016 by the Financial Times. And Warren Buffett also included it in the Berkshire Hathaway 2018 annual meeting bookstore. So, why have we chosen this book, Niklas?
So, we think it's necessary for shareholders to understand how crucial corporate governance is. And many investors are very focused on the products or the market potential, but even if a company performs well, the value is not always directed to shareholders. It's because managers and boards can overstep their responsibility and also miss out on future business opportunities due to short term thinking. But it goes both ways. So, just as companies can take advantage of shareholders, shareholders can take advantage of companies for the good and bad of other shareholders. So, what is Dear Chairman about?
Yeah, the book is about shareholder activism. That is when an investor thinks a company is being mismanaged and tries to influence it into doing something, which, for example, can be to pay a dividend. And the purpose of activists have historically been to gain economic profits, and that is what is mostly captured in Dear Chairman, the book. But it can also be to influence certain decisions in, for example, environmental or social aspects. But how is the structure of the book?
So, the book includes 8 activist campaigns from the 1920s to 2005. When investors have written a letter to the management and the board with various success. And these are real investing legends, such as Ben Graham, Warren Buffett, and Carl Icahn. And a quote from the book that explains the importance of the topic is: shareholder activism can produce stellar investment returns by exploiting weaknesses in public company governance. And from the framework of Red-Eye Quality Rating, what will today's episode focus on?
So, those of you familiar with our quality rating and those who have heard our previous episodes, it consists of 3 different categories. It's business, people, and financials. And this is something that our analysts use when they analyze companies to determine the cost of capital and the risk in a company. So, the quality rating consists of more than 100 questions, and a lot of them are about people, which we think is very central when analyzing a business. And today's episode is very focused on that area. The behavior of the board of directors is really a key pillar of the people rating, and that is because they are responsible for governing the company, and they are supposed to make sure that managers' interests are aligned with those of the shareholders and other stakeholders. So, included in this rating, there are a couple of questions that investors can find useful. For example, if the company is communicating in an honest way, are they allocating capital in a good way? Is the CEO pay reasonable? And are they abusing option plans? And so on. So we think this is very aligned with today's book, Dear Chairman, by Jeff Gramm. And here comes our conversation. Hello, Jeff, and welcome to Investing by the Books podcast. Where are you?
I am in Brooklyn in my basement. Um, my computer at work actually just died, so I'm
Aha,
at home, like while I wait for the new one to show up.
I
Um,
see.
and thank you all for having me.
Yeah, it's great to have you on. And we think your book, Dear Chairman, is really a must read for any board of directors, managers, and shareholders. And one reason is that we think many shareholders don't understand or they don't think about like the fundamental relationship between the board and the shareholders and management. So just to start off, like what would you say is the role of the board of directors?
Well, the board of directors, like their main role is to pick the CEO, right? Like, to hire the CEO, to hold the CEO accountable, and then to provide support. And then there's also kind of a risk management function of the board too, like to be sure that the company is in, compliance with all the things that they need to be in compliance with. But I would say like the fundamental goal is choosing the right CEO and putting them in the best position to succeed. And I think, like a lot of times, like you'll talk to public company shareholders and they'll talk about how it's the board's job to drive shareholder value and to do all these like specific things to add value. But I like to think of it in a more fundamental way, as the main thing is just to pick the right person to lead the company.
Yeah, and in the book you really write well about the intermediary role between shareholders and managers.
Yeah, yeah. Well, it's interesting. I do feel like like that is a topic that hasn't been discussed that much in recent years. There was a lot more talk about it in the 80s when there was the boom in corporate rating. And so I felt that I had a story to tell about that topic, and then that was kind of a good platform to tell a broader business history that had investing lessons with it. And so I think the thing I like about my book, which I feel like I can say now because I'm 5 years removed from it, is I do think that even if you don't care about corporate governance, but you do care about investing and business history, I do think there's a lot of stuff in there, um, that can appeal to lots of people that are interested in business.
Yeah, about the history, it's really interesting because I mean the chairman really takes us through 8 activist campaigns, but it's also, as you say, it's a history lesson of stock ownership in the U.S. And I was thinking it would be interesting if you could take us back to the early days of the 20th century, where you start the story. How would you say that stock ownership have evolved since then?
Yeah, I mean, in a in a funny way, that dynamic, like the way that ownership has evolved, is kind of the key theme of the book, and it kind of drives the history, right? So the first chapter is Benjamin Graham. He does an activist campaign against a company called the Northern Pipeline Company, which it was a part of the Rockefeller empire before they broke it apart. And at that point in time, it was like it tended to be a very concentrated investor base for most public companies. Except for the major railroads, there weren't lots of, individual retail investors in stocks. Like in a given company, like a Northern Pipeline, like you had concentrated interests, like the Rockefellers. And, Ben Graham, who ran, essentially what would be called a hedge fund today, was a little bit of an innovator in that field. There weren't a lot of investment partnerships like his, and so he kind of came into this world where there was a lot of concentrated vested interests. And then what you see as the book progresses is the way that changes through history. And by the 1950s, you know an interesting thing had happened where the markets had become a lot more popular with retail and investors. Like the stock exchanges had done these huge campaigns to promote individual ownership of stocks, and you had this great diffusion of ownership. And with the diffusion of ownership, that ultimately results in a change in oversight. And what really kind of drives the book is this dynamic of ultimately in shareholder activism, it's the shareholder base of the company that kind of defines how the activist can execute change, and if they can execute change. And as that dynamic changes through history, where you had this kind of extreme concentration in the 20s, it broadly diffused into the 1950s, where lots of the big companies were really owned by individual investors. And then in the 60s and the 70s and the 80s, it really reconcentrated back into fiduciary owners, like insurance companies, pension funds, investment managers, and that change and arc, kind of drives the narrative of the book.
And how would you say? I mean, most recently, I've been. I mean, we've all been studying the meme stock phenomenon, and in a way, that's also making um, retail investors that are, as you say, fragmented, but they are getting more concentrated
when they band together.
Exactly, exactly.
Yeah. Yeah. I mean, it's an interesting dynamic, and, it's yet to really have an impact on governance. And to be clear, this is like a thing that like we've definitely, seen through history before. Like you saw in the dot-com boom, for instance, a great increase in a retail ownership. But I think in terms of governance, I think the big dynamic of recent years, which even in my book, like, because I wrote the book in 2015, like it's only beginning to rear its head then, is, the emergence of the kind of the big index funds like BlackRock and Vanguard beginning to flex their muscles. And it's interesting because, there's a faint echo in the 1980s. There was this awakening of the big pension funds, and there's a chapter on Ross Perot where the big pension funds kind of snap out of it, and they're like, wait, we're these big fiduciaries, and like we have this responsibility to be active owners. um, not active, from an investment perspective, but active on the governance side. And you've really seen in the past like 5 years, the Vanguards and the BlackRocks, kind of come to the same realization. And I think that's the story of the current era. And I think if I were going to do like a new chapter, it would have to be some situation with Vanguard or BlackRock.
Yeah, we touched upon this with Jake Taylor from Farnham Street Investments that we talked with in our second episode, and he talked a lot about like that institutions today are not as long term as they should be, and that they could take more responsibility. What is your view on that?
I mean, I think it's interesting. Like, I think that in general, it's very hard to be a long-term thinker, and it's not just like the big institutions. It's like every investor, every CEO, every manager. One of the great challenges of business is, if you have like a decision that you need to make, and the best long-term outcome is a very bad short-term outcome, it's going to be hard to make that decision. And I think that rears its head in lots of different ways, including in governance. And like I think that Vanguard and BlackRock, to their credit, have realized, we are the ultimate long-term owner. Like, we're literally not going to sell these stocks. They're going to be in business for a very long time, and they're going to be long-term holders. And they have realized, that like, that we need like, you know, like to own our shares, and from a governance perspective have that mindset. And the issue, I mean, I think that's like a very noble way to think about it, and I think they're right. But do they have the capability to really do that? And they don't really have the company specific knowledge, you know, on a company by company basis to do it. So that's the hard part. So they're trying, and I think they have good intentions, but they can really drop the ball sometimes.
And they don't really have a very big incentive to actually do that. Their shareholder, like the ones who have money in their funds, are not thinking too much about that.
Yeah, that's like the funny part, right? It's like they clearly do have a big incentive, like to maximize long-term performance, but really the biggest incentive is not to have like a shit show on their hands that they'll be blamed for, right? It's like, they don't want to have like to be the biggest holder of an Enron, and then like for people to say, hey, like you guys were the biggest shareholder, like this happened on your watch. And so, like, in a sense, like the incentives aren't perfectly aligned. But again, I mean, that's the thing. Like I was actually just emailing with another investor about like a stock, and he talked about how the CEO of this particular company is aligned with the shareholders, and I pointed out that you never really get perfect alignment, and I think that is clearly the case in governance. It's like the shareholders and the board and the management. That's this like what kind of three-headed monster like that that controls a company, and like they're never in perfect alignment, as like as hard as you might try to make that happen.
Going back a bit to the main theme of the book, activism.
Mm-hmm.
I reckon you were a former activist, but not as much anymore, if I get it right. Is that correct?
Well, I have done a lot of activism. I serve on 3 public company boards now. Um, I'll probably continue to serve on boards. We've done a proxy fight, but my day job is I'm a fund manager of and my fund, it does a value oriented investing, and like I'm really looking for well run businesses that don't need my input. So if I'm involved as an activist, it's because something has gone wrong. So I'm not the kind of investor that kind of like looks for a fight. So I think like when people say activist investor, like they usually will mean a fund that looks for, situations where they can add value, by shaking things up at the board level. And I think that's essentially um, not what I do. Like I look for companies where I don't have to shake things up at the board level, and at least like because I invest in these like a lot of small illiquid companies, sometimes they do need to be shaken up, and so at least we kind of have that tool in our toolbox if we need it, and I think that can be helpful. Just like so people know that you're serious and that you will fight to the end if you need to. Um, but I don't think of myself as an activist, and I don't particularly think of myself as a great board member.
Well, you're at least explaining the role of activism really really well in the book, and I was thinking, for those who haven't read the book, could you explain a chapter that you like the most to write?
Sure. Perhaps I'll look at the book. It's been so long. Yeah, I think my favorite chapter is probably um, the Ross Perot chapter. One kind of like one thing about this book is because I made it a narrative history. When I first began to think about the structure of the book, each case was essentially going to have a theme, and it was not necessarily going to be like a linear history. Like it was just going to be this kind of discussion of governance with a lot of lessons, and like I wasn't necessarily going to put the thing in chronological order. But then as I began to write it, it just became clear that like this also works as a as a narrative history, well, as a linear history. So why not like incorporate that too and put the thing in order. The point of all this rambling is just to say that I do think that the book is backloaded. I think the last 5 chapters are vastly superior to the first 3, um, and a lot of it is just like by virtue of the situations being newer. There's more material. I can talk to participants. Like I can add more value as the narrator. So I really like the last half of the book. And the Ross Perot chapter, it's fun because Ross Perot is interesting. It's fun because he's doing activism against General Motors, and that company has a very interesting history through which a lot of American business history is rooted. So that's like GM is a foundational company in terms of like American business, and so that gave me a lot of leeway um, to make it like a fun, engaging chapter. But I'll just explain. So Ross Perot was this very famous American businessman. He founded a company called EDS that was, what kind of this early stock market high flyer. There's like, there's a very famous book called The Go-Go Years by John Brooks. That's, a classic in, on stock market history. And I think the opening chapter is about this day when the market crashes, when Ross Perot on paper has lost, some tremendous, $500 million on paper. It's like the biggest, one day loss in history for one person, like something like that. I mean, like the numbers all seem quaint to us now. But but suffice it to say that that he was like the Elon Musk of his day. He was like the technology, company founder who was brash. He was, magnetic. The press paid a lot of attention to him, and he was like a kind of like new era business leader. And GM bought EDS. And as a part of that deal, they put Ross Perot on the board of directors. And, GM at that time was, the dominant car maker in the US. And, they like had even had to kind of depress their business intentionally to keep their market share low because they were so dominant. And, they didn't, I want to get in antitrust trouble. But beginning in the 1970s, um, they began to get chipped away at by the Japanese car makers, and that began to really accelerate through the 80s. And so by the time that GM adds Ross Perot to this board, um, they're kind of beginning to flounder. They're beginning to struggle, and they're seen as this like overly bureaucratic, old world, business that needs to be shaken up. And they bring on, Ross Perot specifically to do that. And this is the story of like what happens, like when those, like when GM and Ross Perot collide. And what happens is it's a gigantic shit show. And, Ross Perot ultimately leaves. He gets bought off the board. They buy back the shares of GM that they gave him, when they purchased EDS for a gigantic premium. And Ross Perot like effectively sticks it to the shareholders. Like he says, look, this is ridiculous if the shareholders let this happen. Like they're paying me this huge amount of money just to leave.
It was
It's an
$700
abusive,
million, right?
yeah, it's an abuse of shareholders. And if they have any spine, then like they'll do something about it. And so this is like about how the shareholders, slowly get awakened by this whole situation. And it's interesting because in the 1980s, there were lots of abuses on shareholders. There were lots of these, takeovers, you know, led by, insiders or outsiders, but, where essentially everyone was getting rich off them except the shareholders. And like these big pension funds, like figure out what's happening and they're angry about it. And GM is kind of this like tipping point where they're like, okay, like, for years we have said, if we don't agree with what's happening, then we will just, um, get rid of our stock. Like, we don't like it, we sell. And with GM, they were finally like, well, you know what? Like, we can't just, sell GM. You have to own GM. It's like, this like blue chip stock that everyone owned. And so they realized that they have to do a better job on governance.
So in a way, he succeeded anyway. I mean, Ross Perot.
It's funny because he both got paid. It's like they let it happen. Because it kind of happened fast and they moved a bit slow. But it caused this awakening because they knew that like it was a debacle that, should not have happened. And so Perot, he kind of danced through a lot of these situations where he kind of got to like the benefits of both sides of a situation. He kind of got to be the hero when he was the guy that got, like in the US, like we call it green mailed, when you're kind of bought out like at above market, which is a real abuse of shareholders. Usually the green mailers are, the guys like, Carl Icahn, who don't necessarily get like to walk away with a good reputation. But Ross Perot, you know, walked into the like the sunset with his, $700 million.
A fascinating story. Are there any lessons for you, like as an investor, or something you have used from this specific story? Or is it just your pattern recognition being better?
I mean, that whole writing that whole chapter just involved all of this, um, background reading on GM. And GM like itself is just completely fascinating. Alfred Sloan's book, My Life at, wait, is it called My Life at General Motors?
Yeah,
Boy, my
quite sure.
brain, like in 5 years, I haven't talked about this stuff. It's just a fascinating book, and it's like a lot about, bringing financial discipline and a focus on return on, invested capital to a big business. And there's just a lot like of lessons like about business that you get, from reading about GM. There's a whole thing, um, in that chapter about John DeLorean, who is a former GM engineer, who's probably the most famous now because he made the car that is in the movie Back to the Future. But he's an amazing guy. I mean, he was like, well, actually, the Elon Musk of his time. Amazing guy, and just his whole story is just filled with tons of business lessons. And his book, which I talk about, um, on a clear day, you can see General Motors, is a fantastic book. So they're just like, we're so many little takeaways.
So, reading all of this material and preparing, and you write in the preface of the book that you became increasingly cynical about how companies are run and that you lack faith in many management teams. Has this changed in the last 5 years since the book came out?
I mean, that came not through my research of the book, but that came through just, being a fund manager. But, to be clear, like I mostly invest in this like little corner of the market of, companies that are less than $500 million market caps, and a lot that are less than 100. And again, like it, there's always incentive alignment issues anyway, but in a lot of the smaller companies, like there's like actual self-dealing. And so like I do feel like one thing that I've kind of learned over time is that incentives are never perfectly aligned. And if you're a good fiduciary, if you really care about the shareholders, it's not going to be because of like this like the structure of your compensation or whatever. It's going to be because it's just this like you have this like in like inherent interest in being a fiduciary. um so that kind of bred the cynicism of just seeing over and like an over again situations where um people screwed shareholders. And a lot of it is like like a lot of the 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 better management teams have like learned to say all the right things, but then when push comes to shove, they won't necessarily do the right things for shareholders if it's not the right thing for themselves. But you know I say that in the context of smaller crappier companies. And I think to paint the entire public company business world with that brush is not fair. Like I think like when you get into bigger companies, you do get just better level directors, better level managers, more professional organizations. So I'm still cynical, but I do think there are a lot of good people out there doing good work that like are trying hard to do the right thing. And particularly at big companies, I think that governance has vastly improved. Um, you know, like especially since the era of Ross Perot, you just have a lot more people paying attention, and like the shareholders, care more than they did then, and it just all feeds itself to better governance. Are there still problems? Yes. Will there always be problems? Yes. But is there always going to, but can there be continued improvement? I think that there can and will. Like I think that things are getting better.
Yeah, I see it like two categories almost. Like one is those really genuine passion business leaders who are just dedicated and just do whatever. They don't even have to get paid for it. They just love what they do. And then there's the others
Hmm.
who you need to keep them under control, and maybe with the right measures you can keep that governance like tight and good, but it's not
That's right.
it's going to work
And
out.
there's also situations where you think you have the former. It's like those, like
Yeah.
you'll be dealing with a person who says all the right things, and like they'll do all the right things until the very moment when, you know,
Yeah, how do
like
you judge that?
there's a deal on the table that is bad for shareholders and they take it.
Yeah.
So it's just hard. Like you just can't really bank like on anything like on that front. And so as an investor, like as a professional, like an investor, you just can, it's, yeah, like I try not to ever take the risk of bad governance off the table. It's always there, and you need to realize it's always there.
Have you experienced it yourself when sitting on boards that the other directors have taken a decision that you feel is wrong?
Yeah.
And have you, because I think Buffett speaks about this a lot, and he says that even though he more or less knows that the decision is bad, he goes with it because it's really
Yeah.
hard to take a decision, that's not in the interest of the other directors.
Yeah. I mean, I've been on boards where, I was on a board where the chairman of the board like received, you know, indications, will take out interest, like, from private equity investors, and the chairman did not tell the independent board members. So
Wow.
I've been like involved in a lot of situations where it's like that. But, usually if I'm on the board, it comes with like a changeover of regime. And so, um, usually like I'm not in the room for that stuff. I'm usually just the angry shareholder like that, you know.
Like us.
Yeah, because I think Buffett, he also just says that what can you do? The only thing you can do
Yeah.
as a director is basically leave.
Yeah.
And
I
what?
mean, I love the book The Snowball. Um, like in a funny way, but like despite the fact that's like a very famous book, I think it is underrated. But like the one thing that is clear as day from that book that you don't get like, from the other Buffett books is just he hates being on boards of directors. Like, and I think there's a quote in there that like his worst, business decision like was ever being on boards.
You don't feel that way?
Oh, yep, I absolutely like I don't love being on boards of directors. No. It's it's fun when you have the right situation when you're all, what kind of, you know, like when you have a strategy and like you're all, moving in the same direction, you have a good CEO, like that's great. But, you know, the difficulty with being on a board is that, and like people talk about it as a cush job, but like when anything goes wrong, it becomes a 24/7 job, but yet you're kind of, like you're dealing with limited information and it's hard. And if you get into things like when you have to hire a new CEO, or if you have like a scandal or like an accounting issue, that stuff is extremely difficult.
Yeah, I think you mentioned that. I mean, if the CEO is right, then much is solved by that. And I think Buffett mentions the same actually. That I mean, conflict of interest disappear more or less when the CEO is right. The hard thing is, of course, to evaluate if the CEO is right.
Yeah.
Um, About, I mean, we've talked about management a bit, and I think we'll get back to that. But the shareholder base is, of course, important as well. How can a company build the right shareholder base, would you say?
Like, it's funny, this is a question that, like, I haven't, really thought about it that much, from the perspective of the company. It's, like I've always been a little bit fatalistic of a company gets the shareholders that it gets, and a lot of it is, index funds, etc. That like that is going to happen regardless. But there's been more people like Larry Cunningham has a book which is about building the shareholder base. I think it's called Quality Shareholders, and like I haven't really thought about it from that perspective, and I think that they're clearly right that like you do see companies that successfully, you know, they take what Berkshire Hathaway did, like where Buffett, like essentially, like over decades, trained his shareholder base in, what they do, which is like essentially just like you say the same thing over and over and over and over again, and like it finally sinks in about being like a long-term organization. And you see other companies doing it in a shorter time frame, and it does like seem like they've been successful at it. Like you have these companies that have kind of built these, you know, compounding growth, like investment base, like it's like little cults, right? It's like cultish like investor bases. Like you do see that, and so um, it's going to be interesting to see how that plays out because I think that ultimately, like as I said earlier, like good CEOs are good at telling you what you want to hear, and I think they've become much more sophisticated at speaking the language of shareholders. And so I'm pretty cynical about it, like in some ways. Like I think like they say all the right things, but then you do see situations that, will kind of blow up because they ultimately don't deliver. Um, so I guess that's a long way of not really providing an answer. I'm not sure how well it can really be done, but at the same time, like I think a key part of of being a CEO is communicating with your shareholder base, right? And explaining what you're trying to do. So when things go wrong, like you have like enough credibility to explain why it went wrong. Like if they know where you're trying to go and you don't get there, um, if you've just been bullshitting them the whole time, then you're in a way worse position like than if you haven't. And if you're open about the risks and then the risks, present themselves or become realized, then I think that you're better off for it. So like I do think that a key thing to being a good CEO is to kind of like to manage expectations right.
So more or less, we as investor we need to follow the story, and if something not follows that story, then get out more or less.
Yeah. I mean, like the hard thing with being an investor, like again, is like I think it's important to talk to management and to engage with them. I think a lot of people don't, but at the same time, it's like we're fiduciaries. Like people have given me money, um, to essentially bequeath upon these corporations, and I think that we owe it to them to kind of get as good of a read on the people like that run these companies as we can. But it's very dangerous because CEOs are good at charming people and they're good at telling people what they want to hear, and it's like it's always a delicate balance.
Yeah, an important part is to look for what they are not telling you. And if
Yeah.
things go south, what are they really telling you that, or are they covering those facts up? And that's of course hard to know. But if you we at Redeye we cover about 150 companies, and we are also in the smaller space, like growth companies usually not value as much, but they are in the same market size that you are in that range basically. And we have a quality rating, and that is about 100 questions in total that our analyst like Niklas and I used before. And one part of that is it's divided into three categories. So it's business, people, and financials. And the people side is really relevant for our discussion here. And one part of that is about communication. And
Yeah.
if they have an open and transparent communication, for example. So it really ties well into that here.
Yeah. I mean, like I think like, the area of, small cap growth is a fascinating one because, so much of it is just dependent on on management and on the kind of like in your long thesis, there's this like succession of things that have to fall in place. And so the dynamic is very interesting because like you'll have a lot of situations that don't work out, but like when you get one that works, they really, 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 work. And so I think that building like a rigorous checklist of like, around trying to find the ones that that work, probably makes sense.
Yeah,
I've never had the discipline to do that kind of thing.
to have a checklist, you mean?
Yeah,
Yeah.
or just like to keep in 100 question checklist and
Yeah, you can
that
take a
kind of
look at
stuff.
our rating, or our CEO is releasing a book later this year that is about those questions. So I
Awesome.
can send
Yeah,
you
but I'd
that
love
one.
to see it.
Yeah,
That's
because I thought
great.
about all of this from the last chapter of the book with BKF Capital, who is
Yeah,
really a capital asset management company, and they are really saying that we invest for growth and we are long term, but then these activists come in and they are way too impatient and they just want to have money on the table today, and they actually destroy the whole company. So I thought that was a really interesting chapter to show like
yeah.
that is not
It's
always
a
good.
it's a fascinating chapter. So it basically is about this company BKF Capital that is a money manager, and in addition to to kind of traditional long only funds, they have some hedge funds which are kind of hot and doing well, multi-billion-dollar hedge funds, which at the time, this was in the 90s or maybe early aughts, I'm sorry. Yeah, I guess this was in the early aughts. um, that's like a couple $1 billion in a hedge fund is a big deal. And and everyone in the industry at that point, like they knew this is a growth industry. And so you had these shareholder activist hedge funds attacking this company that owned a hedge fund about how they compensate their people. And it's it's an interesting situation. I mean, like it's easy to kind of to fixate on the outcome, and the outcome was essentially that the insiders all walked and the stock went to zero. But you really, like you see both sides of it, and like there's always like nuance in these situations. And like the main activist in that one, this guy Carlo, Cannell, like, and I put this like in the book, had like like I think like a very good point of like, I mean, he clearly like like acknowledges this was a disaster and that there was this huge destruction of value. But like as he just will put it, it was just like so stupid. Like that John Levin, like like it was in John Levin's power to find it like an outcome that like would benefit everyone. So it's interesting to kind of like like to try to kind of assign blame
And
because
John
it
Levin
does
was
kind
the
of go.
CEO, right?
He's the
Yeah.
CEO. you know I don't know, it's a like it's a fascinating case, and it like it's easy to see both sides. And it was also kind of easy to see how like with activism there are these kind of tactics that you use like to court the broader shareholder base that like that as we discuss in the book have evolved to kind of like fit the shareholder base of the time. And they kind of like use all these kind of classic tactics like attacking employment of family members and just like all of these things, which in the end really just like poured gunpowder on the fire. But yeah, like I wanted to have a chapter in the book where the activism was a complete disaster. And this was one where it was like a richly valued company before the activists got involved, and it literally went to zero.
Talking about richly valued companies, how how would you say a CEO should run the company when the stock is overvalued? Um, and I don't think you answered it in the book. I think you have that question, but you don't answer it in the book. So I'm asking that question now.
Yeah. Yeah, like I mean I posed the difficulty of it, and like in the I forget the context actually, but but I remember like I was at this luncheon that was at the New York Public Library, where Eddie Lampert gave a talk, and it was kind of peak Eddie Lampert. Well, Sears was high flying, and he posed this question. Like I think he was asked about corporate governance, and he posed like a question and like about like what happens in this kind of like whole equation if the stock is overvalued. How do you do like appropriate will governance, and will motivate your team, and will compensate them properly if the stock is like is ahead of itself. And I think it's a real challenge. Like I have a friend who runs a company, like it's like a software company. They make point of sale software for for restaurants. And I've never talked to him like about this angle of it, but I think he's in a situation where he has like some cultish investors, and he has a stock that's like very richly valued, considering their kind of core product isn't really growing as fast as I think a lot of investors like would like it to. And I think like that becomes like a challenge. Like if you're trying to build like a world class organization, like if you're trying to get the best employees, like you don't want to we'll pay them in stock if like if you're nervous that it might go down. So what, yeah, I mean, I think that's hard. I think you just have to focus on your core business, and then to the extent that you want to kind of play the capital allocation game, like and issue shares, then that's at your disposal. I think the beauty of if you're in charge of a company that's overvalued is in most situations you can generate cold hard cash out of that dynamic, which when you're undervalued and like you want more money, you can't. It's like that is not at your disposal. So there's all these like issues with it, but in the end it's probably a pretty decent problem to have if you have the capability of going to market.
Yeah, you just need to avoid taking on more and more risk, I guess.
Yeah. Yeah, and that's got to be such a like a temptation, right? To kind of to try to live up to the valuation. That's got to be hard.
Yeah, definitely. Enron is a good example.
Yeah.
But talking about capital allocation, we notice like CEOs, they are often hired because they have a good record of being good business operators and salespeople and so on. But what do you think? Like, how can they choose between the best options, paying dividends or buying back stocks or buy a company or invest in a business? How are you thinking about that?
I think it's like it's a real challenge, and and I think that's where the board can play a role. Um, I mean, just to take like the simplest example. So of your five choices, right? You can like deploy in your business, you can do dividends, repurchases, you can do M&A, you can pay down debt. If you just focus on dividends or repurchases, right? Um, lots of companies like, you know, like pick a route, right? There's like a company called Callaway Nursery that I've been an investor in for a long time now, where a friend of mine, this guy Peter, came in, took control of it in 2016, and he basically is a dividend payer. When the cash builds up, he pays out a dividend. And one thing that people like don't realize as much as they should about dividends is both the de-risking nature of it, that you're taking cash out of the business and you're returning it to shareholders, and it is now diversified away from the business. And then the opportunity cost there of like Peter began to pay dividends. I think the first one was in 2017. Since that time, on what was maybe a $2.50 stock when he took control, he's paid $3.50 in dividends. And it's not just the 350, like the shareholders have, gotten to deploy that 350 into a strong market. And so, like for my firm and, for other Callaway shareholders, like, those dividends got invested into faster growing companies. And then there are companies that do repurchases. Like there's this, company, Jewett Cameron Trading, which is like a small, company in the Pacific Northwest. It's an American company, and they make pet enclosures and fences and stuff. I don't own the stock, and it's like it's not like it isn't like a business that you would call a good business, right? They have essentially a commodity product. They sell to a concentrated customer base. Like I think they have a customer who's like, 30% of their sales. He's probably like, Petco or some big box company, Lowe's or something. But what they've decided to do is to buy back shares. And they've like in the past 10 years, they've like retired something like 65% of their shares. And their operating income per share has gone from 35 cents a share to over $1. And in that period, their earnings have largely been flat, right? And so they've done very well with that strategy. And so there are companies that do both, dividends and repurchases well. And if you're going to ask a CEO, like, well, what should we do? It's like they need to kind of understand the nature of what, is it about dividends and repurchases that is, different? And I would say the fundamental difference is there's the bag holding aspect of it, right? It's like if you go with, repurchases, like you're basically taking all the cash flow of the business and you're concentrating the ownership in the remaining holders. And if you go with dividends, you are giving away the capital to shareholders and they get to take it elsewhere. And so the question really is going to boil down to the durability of the business. If the business is like super durable, repurchases are better because like you can really drive crazy value with them. But dividends, if you're not sure, are way less risky from that perspective. And this is the kind of a decision where like if you just task the CEO, they're probably going to be biased to repurchases because they're probably going to have an inflated view of durability, or they should if they're like an optimistic CEO. So I think like these decisions, it really helps when the board can provide some clarity and some insight. And just on that one, it's just important that the board like understands like the bet you're really making when you're choosing one over the other. And so just to take that example, it's like you're really making a bet on, on durability of the business. Is it going to be here after all these repurchases? And then B, on kind of, the opportunity cost of returning the cash now. Like that's like a big factor too. So these are things that I think that the board needs to get involved with. And to do that, it helps if the board, will understands these things. And so, I find especially with something like repurchases, like people don't really understand what they are, how they drive value, like what the risks are with them. And so, like to me, it's important that like that people, will get these things at the board level and they help the CEO make these decisions because there's always going to be a bias on the, like for optimism, like on the part of the CEO. And with capital allocation, it's like, there's like the classic quote from Buffett that what is good, like at one price is, stupid at it, or, well, smart at one price is stupid at another price. That's like the first rule of capital allocation.
In your examples, I mean, you show that more or less the story of the company is either it's a dividend paying company or it's a company that buys back stocks. But with that example you mentioned now, it should the optimal way more or less should be pay a dividend if the stock is overpriced and you don't have good allocation alternatives elsewhere, and if it's undervalued, then buy back shares.
See, not necessarily though. See, because I think that a lot of it is, like to me, the key calculus would be pay a dividend if you're not sure about the, durability. And durability is hard. Like it's easy to like like to say, oh, Jewett Cameron clearly did the best, like the right thing, but like they could have lost their biggest customer, or like things, could have gone wrong. So like to me, it's more like about your risk tolerance for like if I'm gonna embark on a 10-year repurchase program, because it takes time. Like it's like you have to do it with year after year after year and reduce that share base. Like it takes time. Like you need to be confident that you have the kind of business that is going to be there at the end of that time period. And the interesting thing that I found is like if you really break out the numbers, um, there's a little bit of a cliche that like repurchases are, will only good if do them at a big discount. But that's not necessarily true. It's like if you do like a little model of a hypothetical company and you toggle like the price that they're buying back shares, like even if you you set your model to buy back the shares at a premium where you kind of will set like your market prices, um it will do well. And of course the dynamic is that, well, durability. If like if you have a business that trades at 15 times earnings, and then like your model goes for 10 years and they're durable, at the end of that 10 years, I mean, like I guess, like to your point, like I guess the stock was undervalued. But but I think that ultimately the cliche that you need to buy it at a crazy discount is a little bit overstated. It's more just the business needs to still be there.
Really thoughtful answer. Thanks for that.
So another option of allocating capital is, of course, to buy other companies. And in the book, you mentioned the 1980s boom of M&A, and we see that today as well with the SPACs and everything. What's your view on the current environment, and like, is this sustainable?
I mean, sustainable is like it always like depends on your time horizon, right? But
Yeah,
like, will people be buying companies in the future? Yeah, it's like you'll have these like dips and rises, and you'll like you had the 80s, and like the 90s was a big deal decade, but just in different ways. Um, so there's always going to be M&A, and like the seduction there is again like well executed M&A drives well more value than anything, right? Um, it's like both the best and the worst business outcomes that that you can think of, like they tend to at some level like be driven by M&A, right?
I
It's,
guess Berkshire Hathaway is a good example.
yeah, it's like you got your Berkshire Hathaway, and then you have your Enron.
Yeah.
And if Enron had just stuck to the pipelines and not done lots of deals, it's like, yeah, there's the fraud and all this other stuff, but it's like really the the big outcomes are driven by M&A, and people love big outcomes. And you just like you see lots of examples of like I remember when I first got in the business, I worked at a distressed hedge fund, and like we looked at lots of roll-ups because that was always like a nice opportunity to like to short debt, or just like to find things that you could short. And I remember just looking at Danaher and just being like, geez, I mean, just like unbelievably successful at rolling up these like really shitty companies, um, and folding them into their business, and like effectively. I mean, like I'm not like very well educated on Danaher. I was not ever a shareholder, but it feels like they were like essentially just like a like a publicly traded private equity firm, with a platform. And they built tons of value doing it, and it didn't look particularly hard from the outside. So like there's always going to be this like seduction of like how good M&A can be when it is done right. And Berkshire Hathaway like is obviously the most extreme example.
And is this something you look at for your fund or privately?
Yeah, I mean, you have to as a public company investor. I think it's impossible to do our job like without you know we're coming across a lot of companies that do acquisitions. So, but I don't have a real philosophy on it.
You're opportunistic.
And yeah, it's just, but like the one thing, like I guess that I would say is, and it's a little bit back to the point that we touched on earlier of kind of um, like incentives and alignment. It's I never just will paint the picture of just like, oh, like this is an aligned CEO, so they're always going to be aligned, and I don't have to think about it like in the future. It's like I never just give people the benefit of the doubt of always being good acquirers, which is probably a flaw, right? It's like I probably missed, like I didn't buy Danaher, right? So I just have a hard time getting there on like, is like the secret sauce gonna be durable? So, you know, I bought a lot of companies that have had successful acquisitions, but I rarely kind of build into my bull case they're going to keep on doing successful great acquisitions. Like I mean I was just like I read the other day a pitch on like a European a, a flooring company, and it was an interesting pitch, and like it seems good, and it seems like a good team, and they have a history of good acquisitions, but just the stock was valued such, and the pitch hinged on just this future execution of a pretty significant amount of accretive deals, and I have a hard time getting there on those.
Yeah, there's
But
many unknowns.
I'm sorry.
There are many unknown factors in that, and with credit and everything also.
Yep. Yep, exactly.
How would you define your strategy as an investor to beat the market?
I really am a classic, value investor. And it's funny because I feel like, like we, do all these things like that people mock. Like I quote Warren Buffett in our investor letters. Like, our Q2 letter, I talk about Benjamin Graham and, Warren Buffett. And and I joke in it, like, like I think we've done like 60 or something, quarterly letters, and probably 3/4 of those have had either Graham or Buffett in them, and it's a, and like, well, people love to kind of shit on the kind of like this dodgy value guy that quotes, Buffett. But like, I really think about my strategy as the classic. I look at shares as, fractional ownership in a business, and I buy at a margin of safety. And I think you often get this opportunity when you take like a little bit of a step back and you look at the long term, where the market really doesn't look, 3 to 5 years out. And it's not always a quantitative, it's not always like a model. Like you just, sometimes like you think about the end game and you're just like, well, this is clearly going to be worth more. Well, sometimes like you see the kind of the path to growth. Like I don't get fixated on, will trailing earnings, or will multiples, will kind of like, magic formulas. Like I just try to be, thoughtful, to do good research on businesses and find situations where I see an outcome, 3 to 5 years away that's clearly very different from what other people see. And I think that's what value investing is. And it's like so, in some ways, simple. It's hard to execute. And like I've had long periods of feeling like, geez, like it's been a while since I've had a hit. Like, am I good at this anymore? But fortunately, I feel like it always comes back around. Like it keeps working. And like to me, we quote a 90-year-old man and a guy who was born 130 years ago because there are some enduring lessons in what they say. And I just think that value investing works, and it works the kind of old-fashioned way. And I get that, and I've seen lots of of value guys that that have a hard time with growthy multiples or things that look superficially expensive. But like to me, just it's always been about what is this going to look like in 5 years. So like I've never felt like I had to buy like like a stock at less than 10 times earnings or anything like that. So again, I mean I gave you kind of a lame answer, but I think that I describe my strategy as value investing.
It's good. I mean, yeah, some of the discussion about value versus growth have truly distorted that, as you define value investing, is maybe
Yeah.
the real.
And it's kind of funny because that is a thing that that people have said forever. Like that Benjamin Graham and and Buffett have said forever. And Graham was more skeptical of growth and uncertain of it, which I think if in the prime of your career the Great Depression happens, that is probably like a reasonable mindset. But you know like the good value investors have always discussed growth as a component of value.
Yeah, I remember when I sat with the Intelligent Investor. When I started as an investor, it was actually one of the few. Yeah, I think it was maybe number 2 of investing books I read, and I used that formula,
Yeah.
where actually, I mean, as you say, I mean, he takes up growth as a component. I think he has 7 questions or something like that, where the company needs to have at least some growth. And I mean, as we discussed, I mean, if you buy a company that's not growing at all, then I mean, that's not really, if you intend to hold a company for the long term and be a buy and hold investor, then I mean, if it's not growing, then yeah, it will be hard
Yeah.
for an
Well,
investor to earn a
and
return.
and just to tie back to Dear Chairman, it's like if you're buying a business that is not growing, everything else has to be right about it, right? It's like because there's going to be all of these pressures on the governance, um, like the ramifications of of a bad decision, of bad allocation, are so much worse if it's a melting ice cube that like you can make a lot of money by buying those businesses. Like look at Jewett Cameron or Callaway's Nursery. They're both examples of like not really well growing businesses, although Callaway's has been with the pandemic. But you got to get the allocation right then, and that's hard. And I think you know, yeah, I mean, people fixate on cheap, trailing multiples to a fault. And if you're buying a very cheap stock, like there's a reason it's cheap often, and you need to really be sure that they're allocating right.
Yeah, on the other end of that spectrum is the growth taken to its extreme, where you can say that, okay, but this company is going to grow this, and this much. So any price makes sense because you can always calculate it back. But then
Yeah.
if the price is
Yeah. I
already
mean,
moved, like,
I mean, not any price, but I mean, I've been in situations where just like the market is like nowhere near where I see the end game. And it's not that I would pay any price, but um, it's just, it just, well, like, it seems like, you know, it's like you have a long opportunity like to buy the stock. And I mean, it's funny. Like a good example, like we owned Popeyes, which is a fried chicken chain. It was, one of our best investments, and we owned it for, they got bought by Burger King shortly after I finished the book. So we probably owned it. I don't know. I think we owned it for like 10 years. And, they never really did, value added capital allocation. They had a great CEO who was probably my favorite CEO. And she was always very conservative with the balance sheet. And their CFO for the beginning, like I owned it from '09 until they got bought by Burger King, and I'm sorry, '08, 2008, and their CFO for at least half of that tenure was like, to me, not very good. And I remember I once asked him about, they began to do repurchases at some point, and I just asked about, like, I asked a question about timing the repurchases just to gauge how he thought about it, and he completely, like, yeah, and about a price and stuff, and like, he answered, well, you really want to get them done early in the quarter because then they'll have the most like impact on your, on the weighted average share count.
Early in the year, you mean?
Yeah. Well, yeah, like for quarters too. I mean,
Yeah.
the year, the quarter, the whole thing. It was like it didn't have anything to do, like it wasn't about, driving value, right? Like
I
the
guess he
price didn't
was.
matter. It was, but just the situation and like the growth, and they would have added even more value if they had been aggressive on their allocation, but they didn't need to be. It was like an incredible outcome, like great CEO, and well, her conservatism on capital allocation, didn't produce, like, I guess, an optimal outcome in the eyes of shareholders, but like, that was a very low risk path to growth and profits. And it didn't matter that like the capital allocation, like, like was probably not what like a Warren Buffett would do, or I mean, it actually probably was what a Warren Buffett would do, but what like an aggressive hedge fund would do.
Yeah, it's hard when you see some flaws and you still have to, like, everything is never going to be perfect. So you just have to
Yeah,
deal with it. Like, and
yeah.
like when you're investing, what would you say? What are your most common biases and how do you deal with them, like practically?
Like mistakes, or but
Biases like that are facing you.
probably for me, I mean, I'm complacent, right? Like I can be too complacent, and so I can let opportunities slip by without giving them my full attention in the time period when I need to give them my full attention. That's not really a flaw in my actual like investment process. I would guess that probably I'm most fallible with the kind of classic, if I know someone who's smart who's also involved in this thing, it's easier for me to kind of cut corners on some key issue that I haven't really wrapped my brain around. And I've kind of, like early in my career, I really, to a fault, prided myself on, finding my own ideas and like not buying things that other people were in. Um, and I think I've learned over time that that's like, dumb. It's like I've been in this business a long time and I've developed a good network of friends who are good at what they do. And like to not use that network for idea generation is dumb. And I mean, I bet that if in late 2018 that, someone had posted Popeyes on the Value Investors Club, I might have been like, maybe I shouldn't buy this. It's like, like I really wanted to just like to be my own, just like to have my own stuff. And so
Yeah.
I really, yeah. And like, I've really learned over time that that was, misguided. And like, I, will definitely look at what, people I respect like, but then you always have to fight that, like, well, this thing's really good and my friend Eddie thinks it's really good, and there's this one thing that like kind of freaks me out. But well, he figured it out, so maybe I should just buy it. It's like you always have to fight that. So that's probably the biggest thing. And then one thing also is I think that the more that you do this, that you do develop I think like a better short-term trading gauge. It's like I think that if I like quit my job and became a day trader, I think I could be pretty good at it. Um, and so because I think that you learn not to trade every day, but you do just yeah, it's like you see short-term opportunities a lot. And there was one just a couple of days ago where there was a company that did a stock offering and the stock tanked on the offering. And that's the thing that you see all the time where the kind of core people get pissed off and you have like a 1 day, like 15% drop. And then in a week, it's like back to flat. And it's like those things, they're always kind of tempting. As you get older, you're just like, oh, this is definitely going to work. And, and I still try not to do those. And they're probably like a waste of time. And that's probably like a real, like a slippery slope. And you know, and I've definitely kind of like traded my own positions in ways where if I had just like sat tight and held, I would have like done better.
Yeah, I kind of tried the day trading as well a bit after I was a stock analyst. And then I thought also when you see those opportunities, it's so easy. But when
Yeah.
you're actually sitting there, I found it so hard. Like the mental challenge of, okay, the stock is continuing to drop. Should I buy more? Should I sell here? Should I stop?
Yeah.
You really
I
need to have
mean,
a strategy.
that's a key thing is not to just sit there, right?
Yeah.
It's I try to not just sit at a screen thinking about if I should do a particular trade.
Yeah.
Because the more you just sit there, the more you're going to be in, the desire for action like will motivate you. We had this stock where it was our biggest position. And, like with Popeyes, I had kind of learned the lesson of I knew that thing was going to work out. But then, once it got to be like a really big position, like I just trimmed it and trimmed it and trimmed it because of, prudent portfolio management. And so we had this company called The Joint, which is like a chiropractic chain, which I just felt was like the next Popeyes. I mean, there were lots of, like there were lots of differences, but like to me, like it was that kind of a story where it's like I want to go to the beach for like 10 years and just see where it is at the end of that 10 years. And I bet I'm just going to be shocked at like, what's going to happen. And so I told myself, I'm not going to sell the stock as it goes up. And I have a feeling, during the pandemic, like I was at home more. I just was like out more. I was doing a lot of bird watching. I just had this feeling that if I'd been like at my desk all day as the stock just went up and up and up and up, like that I would have sold it. And it was like, I don't know. It's like you have to fight that urge for action. And I think the challenge of day trading is just not constantly trading. But I think that again, it's like I think that people who do what we do have like learned to see the occasional, short-term opportunity. And I think that we could do it where you just like, like you actually do those.
Yeah, I think so. The hard thing is that when you're in a position, it's hard to do something else. You kind of have to
Totally.
like wait, and then once you have sold it, then you can relax. But
Yeah,
while you own it, it's really hard. I think it's
totally.
better to read books.
Yeah.
But
That's my next book too, is going to be about, how to day trade for the long-term investor,
oh,
day trading for the long-term investor.
I don't know if that is called day trading. Trading without a day in the name. Yeah.
Problem is you don't hear too many successful. You don't hear about too many successful day traders for the long term, right?
No, but don't like that Buffett could be a kick-ass day trader.
Yeah, maybe that's the secret sauce.
I guess the ones who have survived, they don't want to tell you their secret sauce. So. But something I thought about when it comes to biases, because you are a major owner in many of like small, pretty illiquid stocks, and when you
Hmm.
have that position, it's quite hard for you to just get out. So commitment bias must be quite strong, or
Yeah,
could be strong.
yeah. Like, and I definitely will fall in love with companies too.
Yeah.
It's like, you know,
How do you handle
um,
that? To be rational, I guess.
probably not optimally, you know. Um, I think the beauty of value investing is that um, if you buy with enough of a margin of safety, you get some leeway to be an idiot around the fringes. And I've definitely had situations where I probably kind of like um, stuck to the story too long. Um, but again, it's like it's this there's this huge balance of like you need to be detached enough to not you know constantly be forced into action, but you need to be engaged enough to be totally on top of the situation. You need to be like to have the commitment to a position where you can get some bad data or some bad calls, or you can talk to like a vendor who hates the company. It's like with every investment, you're going to get like the one call, well, not one, you'll get a bunch of calls from a person who knows more about the business than you do and that thinks it's a total shit show. Like you're going to get those calls, and you need to have the confidence in your long-term view to kind of override those. And that's not a conducive mindset to not also like falling in love with the situation. So it's just like there's always going to be trade-offs. Like you just can't be an automaton that's just not subject to those forces, because they're contrasting forces.
Yeah, and you're facing that more when it's a public company where you need to face that volatility. But if you would own any private
Yeah,
companies, you don't have that situation as much, I guess. Or do you own any private companies?
not in the fund.
Oh, all right.
um, but I'm involved in some personally. I mean, the thing I would say, I mean, it's interesting because I always get asked about activism, um, like from people who want to, like they're new to activism, they're involved in a company where there needs to be change, and they want to do something and they want to know how. And so like they'll call me up, like I read your book, and the first thing like I'll say is like, okay, well, like I'll give you some tips, but the first thing is to get a good lawyer. And because like it's ultimately it's a legal process, and you need to kind of play you know right from that perspective. Like you see people who just they don't get good legal advice, and they'll just have this long engagement with the company, lots of emails back and forth, and they just like have hosed themselves because they just like have they've gotten too close to management, and that can all be used against them now. Like all their supportive emails are now you know will fodder for the company. And so I'll tell them that. But then like the other thing that I'll tell them is like, be really aware if your first activist campaign is your biggest position, that's like a recipe for disaster. Because it's like you need to be like in activism, you need to be willing to kind of to lose like a public fight. Like you need to be willing to kind of look not great publicly, but get the right outcome.
Ross Perot.
Like if you're like afraid to lose, yeah, like you don't want, then that's a bad situation. And if it's already your like, your biggest position, and then you get active in it, and then it becomes a liquid, and I mean like you're going to fall in love with that position. Like you're going to like lose your perspective on it. So that's a thing that like I always, stress to people.
It's been. I think we could go on and on and on about these subjects, but I mean, investing by the books where we come from are really we are studying books and reading books, and we loved your
Oh yeah,
book.
we never talked about investing books.
Yeah, exactly. And now we have the time. So
Oh, okay, good.
do you have any good one? I mean, I usually think it's hard to ask that questions that question,
Yeah.
because it's really subjective. I mean, it's usually, at least myself, I read a book that I find will help me right now, and I guess
Yeah.
that's the case for everybody. But do you have any general books that you recommend?
Yeah. I think also like the hard thing is like the well, time matters. It's like, one of my favorite books is Joel Greenblatt's You Can Be a Stock Market Genius. It's probably the book that had the most impact like on me as an investor. But it's been like 20 years since I read that book. So I tell people it's like my favorite investing book, but I mean, I should go back and read it at some point.
Was
Because I
it at the
was
time
just
he
like a
taught
different
you?
person.
Was it at the time he taught you at Columbia, or?
Yeah.
Yeah.
That's the only way that I heard of it, is that like I happened to fall into his section, and then I got his book and I loved it. So I was very lucky in that respect. And then there's also the dynamic of now we know lots of people that write books, and like you don't want to like forget your friend's book or something. But I mean, like I love the Greenblatt book. I love I really do like this, like the Snowball. Like I think that's a valuable book. I'm a little behind. Like I haven't read a lot of the newer investing books. Um
How was it
and
when Buffett recommended your book in 2018, and that he had it in on the AGM? Must have been.
well, what's interesting is like he never actually publicly recommended it. Like he put it in the bookshop, which is awesome, but like he never actually put it in the letter. And I knew he liked it. Like I got word back. So like I had sent a galley to Carol Loomis, and she had written back that like she'd already heard about it from Warren. And then I had another friend who knew Warren, who he gave it to her. So I knew he liked it. And so that year that it came out, I was kind of waiting for. I was like, maybe he'll mention it in the letter, and he actually didn't. He mentioned Jeremy Miller's book, uh, The Warren Buffett Ground Rules, which was actually put out by the same publisher. Um, and interestingly, that year at the meeting, Carol Loomis asked a question where she talked about my book, and she even said that he like had recommended it in the letter. And so like it kind of like it made me think, well, did he have it in an earlier draft? Like was it was he gonna recommend it? But like he never actually publicly recommended it, except that he did include it in the Bookworm store. Um, but it's cool. I mean, the book, all of the like I don't like I wrote the book because I like to write, and I just like I thought it was fun, and it was like a project, like like doing a marathon or something, where like I wanted to have done it. Um, but like I didn't know what like was going to come out of it, and I've just been blown away by just like that kind of stuff was so fun, and I've met lots of people that help my business. Like the returns for my fund are way up post book, which I think has a lot to do with all the like the people that I met, and I just think the whole thing has been so valuable that like I was gonna do it like initially under a pen name,
Mhm.
and my book agent was like, no way. But I'm really like, because I thought that like in the hedge fund business, if you're perceived as a like as a dilettante, then people are really mean to you. It's like they like to kind of take down people, and I just thought, well, if I do a book, it's gonna like people are probably not gonna be that nice about it because I'm supposed to be a fund manager. But
Okay.
it turned out to be awesome. So like like that was an unfounded concern.
Great. And do you want to write any more books?
I do. I just like I
Nice.
need the right idea.
Day trading.
Yeah, it's brutal. It's such misery.
A
And
year as a day trader.
yeah, Like, how can I write when I can be so successful day trading? It's just like, like you only have, so many hours in the day.
Yeah.
Um,
But would you like to read more than you do? You say you don't read that much lately, or are you reading classics?
well, we sold an investment, so like I have all this cash. I've been looking at investment ideas.
Mm.
Um, I don't know. Like, I mean, I'm reading the Sackler book now. Empire of Pain, which is great. Um, it's fascinating. Like, I like these what kind of business behind the scenes business books. Like, one thing that like I've been enjoying is the guy who wrote Bad Blood did like a podcast. So like when Theranos went to into like all of the litigation and the shareholder suits and like the criminal like investigation, all of this new material, like all of the texts like between Elizabeth and Sonny, all became like, if not public, like like available to reporters. And so there's all this new material. And so John Carreyrou did a podcast, and I was not interested at all. It was like, I think like a lot of us just read Bad Blood, and it was good, and that's all I need from that. Like, I have like fatigue over that whole story, but then I listened to the first episode and it was awesome. So I have been enjoying that too. It's called Bad Blood: The Final Chapter.
We'll check that out.
Yeah, but there's a lot of new like the William Green book I want to read. There's a lot of new books that I want to read. I just like I haven't.
You can start with listening to our episode with William
I
Green.
will.
Yeah.
Oh, all right. I'll do that.
The one before you.
I do think that the Snowball is awesome. Like, if you guys can get on Alice Schroeder, that would be cool.
Yeah, that would be fantastic. So Jeff, this has been a really great conversation. Where can our audience follow you?
I'm on Twitter, Jeff _ Gramm. You can always email me at banderapartners.com. I'm around. I've become less good at the kind of we'll meet for coffee thing. Like, I don't really do that anymore because I'm at home more.
There's been a pandemic, or is a pandemic, so
yeah, exactly.
there's a good reason.
But I try to be responsive, and like I'm always happy to talk about stocks.
Great. Well, let us know if you come by Stockholm for a coffee.
All right. I think hopefully November. Like if they lift the ban, then I'm going to be in Sweden before the end of the year.
We'll hope for that. Thank you so much, Jeff Gramm on Dear Chairman. Take care.
All right. Thank you all so much.
Thank you for listening to Investing by the Books, a podcast by Redeye. You can follow us on Twitter at IB_Redeye and email us at ib.podcast@redeye.se. To improve the podcast, we really appreciate your feedback, so please rate and review us. Notice that the content in this podcast is not and shall not be construed as investment advice. This information is meant to be informative and for general purposes only. For full disclaimer, visit redeye.se. For the editing of this podcast, we thank Jon Hintze, and for the graphic design, Jesper Viking. I'm your host, Eddie Palmgren, and until next time, I sincerely wish you the best of luck on your journey through life and investing.